Welcome to The Explainer. So today we are digging into a pretty fascinating piece of financial mechanics. Have you ever looked at a company's balance sheet and realized, wow, they're sitting on a massive pile of surplus cash? We're talking way more money than they actually need to run their day-to-day business or even fund new projects. Well, what happens next is this really strategic maneuver that directly impacts your portfolio.
Okay, let's dive right into this. I want you to imagine you're holding a position in a company, right? And suddenly, the management team looks around and decides, you know what? The pie is just getting too big. They need to get that excess cash out of the corporate bank accounts and put it directly back into your hands. But here's the trick. They're not going to do it by just writing you a standard dividend check. No way. Instead, they trigger a completely different operational workflow. It's called a capital distribution. So to understand how this all works, here's our roadmap for today. 1. The surplus cash dilemma. 2. Bricks versus fruit. 3. The par value shift. 4. Mandatory rules and dates. And finally, 5. The tax advantage. Let's peel back the layers on this financial machinery, taking it all the way from a really simple analogy down to the nitty-gritty tax realities.
All right, Section 1, the surplus cash dilemma. Let's see what actually happens to all that cash. When a company finds itself facing this exact dilemma and decides, hey, we need to return this extra money to you, the position holder, they initiate what's called a capital distribution. You might also hear it called a capital repayment. Basically, it's a strategic move where a company literally hands you back a piece of their original ingredients. It's a return of issued capital, or capital reserves. Now, it is absolutely crucial to get this. This is a completely different animal than getting a standard dividend check. You are not getting a slice of new profits here, you're actually getting a refund on your initial contribution.
To make this crystal clear, and yeah, at the risk of sounding like we're back in kindergarten for a minute, let's use a really simple mental model. So imagine you and your friends pool your capital together to buy a giant bucket of Lego bricks so you can build a massive castle.
You spend hours and hours building, and eventually the castle is completely finished. It looks great. But you look down and you realize you've still got a bucket full of extra bricks that just weren't needed for the build. So instead of hoarding those leftover bricks where, someone's just going to step on them, the group decides to hand them back to everyone who originally chipped in. The real beauty of this? You still own your exact same share of the completed castle, but now you've also got some of your original investment right back in your hands. And that is exactly what a company is doing when they issue a capital distribution.
Moving on to Section 2. Bricks versus fruit. Let's talk capital versus income.
And this brilliantly illustrates the core difference between these corporate actions. I want you to think of a standard dividend as the fruit, right? It's a distribution of a company's earnings. It's the shiny new value grown organically because the business is operating successfully. A capital distribution, on the other hand, is the bricks. It is a return of the company's issued capital. So when this happens, the issuer is basically paying each shareholder a proportion of the value of their shares in cash, but it's coming straight out of the company's foundation, not its harvest.
Okay, Section 3, the par value shift. Time to look at dynamic value change.
So when these corporate bricks are returned to you, there's actually this fascinating mechanical sleight of hand that happens behind the scenes in your portfolio. Here's the real surprise element. Unlike a stock split, where your share count magically multiplies or divides, in a capital distribution, the number of shares you own usually doesn't change at all. You check your account before the event, you've got 100 shares. You check it after, still exactly 100 shares.
Now, what's really interesting about this is that even though your actual share quantity remains completely identical, the underlying official face value of those shares drops. Let's say it drops to 80 cents. The underlying value is changing dynamically, but that share count, it just sits perfectly still.
Let's actually walk right through the math to show you how this nominal or par value shift works. Step 1. Let's say you own shares with a nominal par or face value of exactly $1 each. Step 2. The company realizes, hey, we have surplus cash, and they return 20 cents in capital to you for every single share you own. Step 3. Well, because they gave you back 20 cents of the original ingredients, your share count stays exactly the same, but the official face value of those shares is legally reduced down to 80 cents.
Which brings us to Section 4, mandatory rules and dates. Let's get into the operational workflows.
So in the world of global financial operations, a capital distribution is actually categorized as a mandatory event. And that means exactly what it sounds like. You don't get a choice in the matter, and you definitely don't need to send in an RSVP to participate. You aren't electing to receive this cash. Management has unilaterally decided that the pie is too big, and they are automatically sending that excess right back your way. To trace the actual journey of the corporate dollar, we have to look at the timeline. It all starts with day one, the declaration, which is just where the company announces their intent to distribute the capital. Then comes day two, the critical record date. On this day, the registrar's books are locked down tight. Basically, if you are on the books as a shareholder on the record date, you're getting paid. And finally, we hit day three, the effective date. This is when the cash actually leaves the company and the share price adjusts.
Let's pull back the curtain on that effective date for just a second because it's pretty wild. On this exact day, operations teams have to be incredibly precise. The market price of the stock will almost always drop to reflect the exact amount of cash that just left the company's bank account. If the systems aren't perfectly synced to show that cash arriving at the precise moment the share price drops, well, investors would log in, see a drop, and panic, thinking they just lost portfolio value for absolutely no reason.
And finally, Section 5, the tax advantage. Let's talk taxation and accounting.
For anyone actively managing these positions, the most critical distinction of all comes down to the tax treatment. So the crucial point really is this. When you receive a standard dividend, remember, the fruit of the business, it's typically treated as income. That means income tax and standard withholding tax usually apply. But a capital distribution, that's a return of your original ingredients. Because you aren't earning new money, and instead you're just receiving your own initial investment back, this triggers a capital gains conversation. In a lot of jurisdictions, this actually allows investors to completely avoid the usual withholding tax that comes saddled with a standard dividend. It's a real game changer.
Ultimately, understanding a capital distribution means recognizing when a company is, as they say, thinning its own DNA to stay lean and return value. It's not just some random bonus payment that magically shows up in your brokerage account one morning. It is the complex, highly regulated machinery of the financial markets actively rebalancing the scales. It ensures that if a company has more capital than it efficiently needs, that value is pushed exactly where it belongs. Back to you.
Which leaves us with this final thought to chew on. How does this financial DNA thinning impact your own portfolio strategy? I mean, the next time you look at a company sitting on a mountain of cash, you are going to know exactly what happens when they decide to hand those original Lego bricks back to you. Thanks so much for joining me for this explainer, and keep learning.